Most investors think Dividend Aristocrats are the safest stocks out there, but 2025 has been anything but easy for them. Some have surged over 80%, while others are deep in the red. And some of the best opportunities right now are hiding in the middle of all that noise. In today's video, I'm breaking down the best Dividend Aristocrats for December 2025, looking at performance this year, the latest dividend growth updates, and which names look most undervalued right now using dividend yield theory. If you're building a long-term dividend growth portfolio and wondering which aristocrats deserve your attention heading into the end of 2025, this video will give you a roadmap. Let's start with how the Dividend Aristocrats have done overall this year compared to the market. October was another rough month for the aristocrats. The ProShares Dividend Aristocrat ETF, ticker symbol NOBL, fell about 1.4%, while the S&P 500 ETF, SPY, rose by 2.4%. But the script flipped in November. Through November 27th, Noble was up 3.1%, while SPY was actually down 0.35%. So we did see a reversal late in the year, but zoom out, and year to date, Noble is up only 6%, while SPY is up more than 17%. That's a massive gap. The aristocrats have underperformed the broader market in 2025, and that's exactly why this year has been interesting, because underperformance can create opportunity. Performance has been all over the map among individual aristocrats. As of late November, 36 out of the 69 aristocrats are positive for the year. 26 have double-digit gains, but only 19 have managed to beat the S&P 500. Here are the standout winners of 2025. Cardinal Health, up 82%. Caterpillar, up 60%. C.H. Robinson Worldwide, up 56%. Albemarle, up 48%. Johnson & Johnson, up 46%. IBM, up 41%. Nucor Corporation, up 38%. Expeditors International of Washington, up 34%. Medtronic, up 33%. AbbVie, up 32%. General Dynamics, up 30%. And Atmos Energy, up 28%. These are huge returns for established dividend stocks, especially compared to how flat many income stocks were in 2022 and 2023. Zooming in on just November, the 5 best performers among the aristocrats were Albemarle, up 29% for the month, Expeditors International of Washington, up 21%, Kenvue, up 20%, Medtronic, up 16%, and Cardinal Health, up 12%. These sharp rebounds hint at what we've been seeing all year: money rotating back into safety, income, and high-quality companies after a speculative first half of 2025. Now let's talk about what really matters to long-term income investors: dividends. So far, in 2025, 66 out of the 69 aristocrats have increased their dividends, which keeps the group's income consistency alive and well. Just in the past month, we have seen 12 new dividend increases announced, although 3 of these won't show up until the first quarter of 2026. Let's run through them all. Automatic Data Processing increased its dividend rate from $1.54 to $1.70, a 10.39% increase. The new rate takes effect in Q4 and translates to 10.10% dividend growth for 2025. For context, in 2024, ADP increased its dividend by 11.46%. Amcor plc increased its dividend rate from 12.75 of a penny to 13 cents, a 1.96% increase. The new rate also takes effect in Q4 and translates to 1.99% dividend growth for calendar year 2025. Last year, Amcor increased its dividend by 2.03%. Atmos Energy increased its dividend rate from 87 cents to a flat dollar, a 14.94% increase. The new dividend rate takes effect in Q4 and translates to 9.89% dividend growth for 2025. Last year, Atmos Energy increased its dividend by 8.6%. Becton Dickinson Company increased its dividend rate from $1.04 to $1.05, a 0.96% increase. This new, marginally higher dividend rate takes effect in Q4 and translates to 7.2% dividend growth for calendar year 2025. In 2024, Becton Dickinson increased its dividend at a rate of 5.71%. Brown-Forman Corporation increased its dividend from $0.2265 to $0.321, a 1.99% increase. This dividend bump takes effect in Q4 and translates to 3.48% dividend growth in 2025. slightly below 2024 dividend growth of 5.47%. C.H. Robinson Worldwide increased its dividend rate from 62 cents to 63 cents, a 1.61% increase. It takes effect in Q4 and translates to 1.22% dividend growth for 2025, which is low, but it's slightly better than last year's increase of 0.82%. Emerson Electric increased its dividend rate from $0.5275 to $0.555, a 5.21% increase. The new dividend rate kicks in Q4 and translates to 1.66% dividend growth in 2025, which is nearly twice as good as the 2024 dividend growth rate of 0.84%. McCormick increased its dividend rate from 45 cents to 48 cents, a 6.67% increase. It also takes effect in Q4 and translates to 7.02% dividend growth in 2025, which is slightly slower than 2024 dividend growth of 7.55%. ExxonMobil increased its dividend rate from 99 cents to $1.03, a 4.04% increase. The new rate takes effect in Q4 and translates to 4.17% dividend growth in 2025, which is slightly below 2024 dividend growth of 4.35%. The following three aristocrats announced dividend increases that all go into effect in Q1 2026. AbbVie increased its dividend rate from $1.64 to $1.73, a 5.49% increase. Aflac bumped its dividend rate from 58 cents to 61 cents, a 5.17% increase. And Roper Technologies increased its dividend rate from 82.5 cents to 91 cents, a 10.3% increase. These three bumps will boost 2026 income, not 2025, but they matter long term. When we average everything out, dividend growth across all aristocrats in 2025 is 5.46%, which is slightly lower than 2024's 5.78% rate. So not a banner year, but still perfectly healthy growth for an income portfolio. Now let's get to the part investors really care about. Which aristocrats look attractive to buy right now? I focus on two things. Valuation using dividend yield theory, where we compare today's yield to the stock's 5-year average, and look for higher than normal yields that often point to undervaluation. And number two, the expected long-term return, which I put together by combining three different things: earnings growth, forward dividend yield, and the upside from reversion to fair value. If these three components add up to a 10% plus expected annual return, then the stock makes the list. As of late November, 28 dividend aristocrats passed both tests, showing undervaluation and a 10% expected long-term return. Let's take a look at all 28 right now. First up is Abbott Laboratories, that looks about 3% undervalued. It supports a forward dividend yield of 1.84% and has a return estimate of 12.78% per year over the next 5 years. Number 2 is Automatic Data Processing, that looks about 21% undervalued with a forward dividend yield of 2.67% and an expected rate of return of nearly 16%. Next we have A.O. Smith, that looks about 18% undervalued. It supports a forward dividend yield of 2.17% and has an expected return of 11.46%. Next we have Air Products and Chemicals, that looks about 11.5% undervalued. It has a forward dividend yield of 2.76% and a return estimate of 13.74%. Up next we have Becton Dickinson & Company, that looks about 26% undervalued. It has a forward dividend yield of 2.17% and a return estimate just shy of 12%. Next we have Brown-Forman, that looks about 49% undervalued. It has a forward dividend yield of 3.21% and a return estimate just north of 12%. Up next we have Franklin Resources, that looks about 16% undervalued. It sports a forward dividend yield of 5.68% and has a return estimate just shy of 16%. Next we have Brown & Brown, that looks about 18% undervalued. It has a low forward dividend yield of just 0.82%, but sports a forward return estimate of 14.6%. Up next we have Clorox, that looks about 31% undervalued. It has a nice forward dividend yield of 4.6% and a return estimate of 15.5%. Next up is Cintas, that looks about 4% undervalued. It sports a forward dividend yield just shy of 1% and has a return estimate of 12.39%. Up next is Erie Indemnity, that looks about 4% undervalued. It sports a forward dividend yield of 1.86% and has a very nice return estimate of 26.59%. Next up we have Eversource Energy, that looks about 16% undervalued. It has a nice dividend yield of 4.51% and a return estimate of 12.37%. Next up is FactSet Data Research, that looks about 41% undervalued. It has a pretty good forward dividend yield of 1.59% and a return estimate of 14.75%. Next up, we have Hormel, that looks about 41% undervalued. It sports a forward dividend yield just shy of 5% and has a return estimate of nearly 21%. Moving on, we have Kimberly-Clark, that looks about 22% undervalued. It has a pretty good forward dividend yield of 4.65% and a return estimate just north of 11%. Next up, we have Lindy plc, that looks about 5% undervalued, with a forward dividend yield of 1.47% and a return estimate of 10.66%. Next, we have McCormick & Company, that looks about 29% undervalued. It has a forward dividend yield of 2.85% and a return estimate just shy of 13.5%. Next up, we have Nordson, that looks about 18% undervalued, with a forward dividend yield of 1.38% and a return estimate just shy of 12%. Moving on, we have NextEra Energy, that looks about 4% undervalued, with a dividend yield of 2.65% and a return estimate of 11.7%. Next up, we have Realty Income, that looks about 11% undervalued. It sports a forward dividend yield of 5.65% and has a return estimate of 27%. Next up, we have Pepsi, that looks about 20% undervalued, with a forward dividend yield of 3.85% and a return estimate of 11.11%. Up next, we have PPG Industries, that looks about 32% undervalued, with a forward dividend yield of 2.84% and a return estimate of 12.77%. Next, we have Roper Technologies, that looks about 29% undervalued, with a dividend yield of 0.82% and a return estimate of 14.78%. Next up, we have J.M. Smucker, that looks about 22.5% undervalued, with a forward dividend yield of 4.26% and a return estimate just north of 10%. Up next, we have Stanley Black & Decker, that looks about 30% undervalued, with a forward dividend yield of 4.62% and a return estimate of 26.5%. Next, we have Cisco, that looks about 9% undervalued, with a forward dividend yield of 2.85% and a return estimate just shy of 12%. Moving on to T. Rowe Price Group, that looks about 20.5% undervalued, with a forward dividend yield just shy of 5% and a return estimate just shy of 12%. And finally, we come to West Pharma, that looks about 21% undervalued, with a very low forward dividend yield of just 0.32%, but a return estimate of 13.5%. All in all, these names combine attractive yields relative to each stock's own 5-year history, discounted valuations, and solid long-term growth assumptions. In other words, you're not just buying income, you're buying potential total return. My formula for expected return is simple. I simply add the projected earnings growth, the forward dividend yield, and valuation mean reversion over 5 years. This blends income, business growth, and valuation, which is critical, because the best dividend stocks are not just the ones with the highest yields. They're the ones where yield, growth, and valuation align. One quick reminder, these valuations and expected returns are estimates based on assumptions. They are not predictions. Markets change, growth projections change, and dividends can change. Always do your own research before investing. 2025 has been a challenging year for Dividend Aristocrats, but that weakness has created opportunities for patient investors. Dividend growth remains intact, and several high-quality stocks are trading at historically attractive yields, giving you the chance to lock in strong long-term income and return potential. If you found this breakdown helpful, make sure to hit the like button. It really helps out the channel. And if you want more dividend-related analysis from me, you can check out my newsletter, Quality at a Fair Price, or Patreon page, both linked below. I share a lot of content for free with some bonus items for paid members. One such bonus item is full access to my Google spreadsheet where I crunch all of the analysis for the Dividend Aristocrats, including the tables and charts I showed you today. I hope you enjoyed the content. Thank you for watching and see you next time.